As 2017 comes to a close, we're getting another example of how bear markets produce big opportunities. Shown on this spreadsheet is the returns for 85 different sector ETFs in 2016, and they're sorted by ascending returns. So you can see that among the worst performers in 2016, the solar ETFs led the pack, followed by wheat, and then biotech ETFs IBB and XBI were two of the worst performing ETFs in the market. And the healthcare ETF XLV was one of the worst performing ETFs of the broad market divisions for the year. Now, if you fast forward to what's happened so far in 2017, you can see that XBI is up over 17% this year and is almost leading the market. And the IBB Biotech ETF is up over 10% this year. And also the IHI Medical Devices ETF is up almost 14%, and again is almost one of the leading ETFs so far this year. So you can see that the bear market in biotech and the healthcare sector has had a major turnaround so far in 2017. Now, taking a look at the healthcare ETF XLV from a long-term perspective, we can see that starting way back in 2002, the XLV ETF essentially ground sideways for about 10 years. Way back in 2002, it was only at about 25, and it was still at that level, or close to that level, all the way towards the end of 2011. And of course, we had the major bear market in 2008. But things changed dramatically for XLV. After that, the 2008 collapse, a bull market started and then really started accelerating in 2012, and really the healthcare sector became the leading sector in the market over the 3-year period from 2012 to 2015. And you can see this on the chart of XLV against the S&P 500, where starting in 2011, XLV started trending higher above this moving average, which is graphing XLV directly against the S&P 500. So this shows outperformance in the healthcare sector over this time frame. And then once this ratio topped out, we got a sideways bear market in the healthcare sector, and it's still been underperforming the S&P 500 until now. So one of the things that I'm going to be looking at going forward in 2017 is whether the ratio here goes back to the upside and healthcare starts outperforming the S&P 500. And notice here that we have this sideways basing formation, and we're starting to crack above the resistance that was established over the last couple of years. And the basing formation is kind of representing like a W formation, where the last pullback was shorter than the earlier pullbacks, which could mean that it's setting the stage for a new rally. Now, looking at the IBB ETF, the same kind of thing happened with XLV, where it went sideways for a long period of time and then broke out into a major bull market. And what happened to IBB, which was interesting in 2014, is it kind of made a spike top, had a big correction, but then went on to gain about 100% in just over a year, which is actually typically what happens in a market that explodes into a short-term top. And what happened after that was a pretty sizable cyclical bear market in IBB, where it lost about 40% in a short period of time. And IBB has been basing ever since then, and is slowly starting to break out of this base as we start, or potentially break out as we start 2017. And notice again that IBB went from dramatically outperforming the S&P 500 to underperforming over the last couple of years, but now it's kind of establishing this base with its relative strength. And again, we're looking for a break above this ratio, signifying that healthcare is once again leading the market. Now, drilling into the XBI Biotech ETF on a shorter term time frame, the same kind of thing with IBB where we had that big bear market in 2015. But notice that the XBI ETF is actually outperforming the S&P 500 so far, and this has been going on since last fall. And one of the things that occurred on this ETF along with IBB is a big volume spike during the week of the election. And we saw this in other ETFs like XLF and the Industrials ETF, but this shows that kind of like the bear market that was in place could have been negated as far back as when this occurred, because this spike above the 30-week moving average might be signifying a stage 2 breakout. And notice how we got a retest of the moving average and then another push higher. So in kind of a stealth way, we could be seeing the early signs of a renewed biotech bull market. And one of the things that I'm seeing in a lot of research I've been doing over the past month or so is a lot of biotech stocks popping up in stocks that are moving up on high volume out of basing patterns, which tells me that explains why biotech is starting to lead the market so far in 2017, is I'm seeing a lot of leading stocks come out of that sector. So one of the things I'm going to be looking at as the second quarter starts is whether the biotech sector has more stocks moving into stage 2, and as well the rest of the sectors in the healthcare area, such as medical appliances and medical instruments, have stocks moving into stage 2, and I want to see volume coming into these stocks, signifying that a new bull market in the healthcare sector is starting to emerge. To get more information on the stage analysis trading system, check out my stage analysis page at nextbigtrade.com, where I go over the components of the system. And of course, check out Stan Weinstein's book, Secrets for Profiting in Bull and Bear Markets, which is a great read that describes in depth how the system works.